I don't think it's by chance that America has had more innovation happen in it than every other country. I think it's about incentives. And there are incentives here that if you innovate, if you provide a good for this country, you benefit for it with wealth. And I think that's what drives people to this country to innovate here versus innovate in other places. And so capitalism helps human flourishing. It provides a massive good, and you don't have to apologize or have to lower the amount of profits that you make to provide that good.
Welcome everyone to this live recording of the Liberty Ventures podcast. My name is Alexander McCobin, one of the founders of Liberty Ventures, and I am so excited for this conversation live with so many amazing individuals, people a part of the Liberty Ventures ecosystem, and just good friends, good people here at my old family farm in Pennsylvania. And today I'm going to be talking with Matt Cole, the CEO of Strive Asset Management. And I want to first off say, Matt, love that you're doing this podcast recording after we finished a 2-hour obstacle course race around the farm. You've got your medal on you there. Really appreciate that. And you're chipper, you're excited. Thank you for doing this after that grueling experience.
It was great planning on your part to have us jump in a freezing cold pond, which just wakes you up. Although after 2 hours later of different obstacles, if I fall asleep during this interview, that is why. But feeling good, it was a lot of fun. This was not a participation trophy. These things were earned.
100%. Well, we're going to keep you on your toes to keep you awake. And I want to just start by giving you a chance to introduce yourself, your background, and what Strive Asset Management is doing, because I don't think I could encapsulate it nearly as well as you will. So for everyone listening that's not familiar, what's your story?
Awesome. So a year and a half ago, I moved to Columbus, Ohio from California. Unlike many of the nomads in this room, that's been awesome to meet, I lived in California my whole life. The opposite. I worked for the largest pension fund in the United States, CalPERS, and had spent my entire career there, 16 years. Rose up very quickly to become a portfolio manager, was managing $70 billion for what became the tip of the sphere of what I'll call the corporate ESG movement. And it was really an interesting experience because my parents were law enforcement officers and they had their pensions at CalPERS. My uncle had his pension at CalPERS. And I went to school right in the middle of the Great Financial Crisis. And during the Great Financial Crisis, the funded ratios of every public pension plummeted from having enough money to pay the people that had their pensions at these pensions to not having enough money. And it was a huge issue. It's a huge issue to this day. It's not going away. And so my why did I join CalPERS was to help provide a secure retirement to people that served California like my parents. It was a very motivating personal mission to me, and it drove me, and I had great success. I was their top performing portfolio manager. I was managing actively managed funds, and my funds outperformed their benchmark every year and were among the top performing funds in the entire industry, even outperforming BlackRock, PIMCO, all those likes. But what started happening towards my last several years there is I was picking up pennies in front of a steamroller, and it was becoming increasingly clear. I made alpha over what they wanted me to do, of over $1 billion while I was there. A lot of money. But the hole that they have is a multi-$100 billion hole. And it was going to take drastic change to actually fix that. And drastic change was going to need to be an unapologetic pursuit of capitalism. That the purpose of a for-profit corporation is to make money, to maximize value. And obviously, we've talked about this, capitalism provides a ton of good. But as an asset manager, that's almost not the point. We have a fiduciary duty. We have a fiduciary duty to the people that entrust us with their retirement assets to maximize value. You sign up to do that. You sign up to put the client above your own individual interest, your company's interest, and the company at CalPERS was the state of California. You have to put the retiree first, and that was not happening. And so my wife and myself became very, very interested in this, specifically at the end of 2019. Because what happened then was that 181 CEOs, including the CEOs of the largest asset managers in the world, Larry Fink, the CEO of Vanguard, pledged to move American corporations away from shareholder primacy. So shareholder primacy is the idea that the purpose of a for-profit corporation is to maximize value. And the statement says that that's outdated today. And I don't believe that's outdated, and I believe that's a massive breach of fiduciary duty. So we started trying to fix it. Long story short, through that journey, met Vivek Ramaswamy, who was also trying to fix it and was working on the same problem. We joined forces, moved to Ohio to tackle this together. He obviously is now running for president of the United States. When he decided to do that, he put me in to be CEO of Strive, and we've become the fastest growing asset manager in the country. In June, we were ranked that. We have just over $1 billion of AUM, which we are very proud of. But here's the reality. We're going up against $20 trillion, 1 billion versus 20 trillion. This is David versus Goliath, and we've had a lot of success, but there is a big fight to happen to save capitalism in America.
I think this is going to be a fascinating conversation because, as we've talked about before, I was CEO of an organization called Conscious Capitalism that is about helping businesses elevate humanity by focusing on a higher purpose than just maximizing profit and taking care of all of their stakeholders. Now, in my mind, that may not be so different from what you're talking about, because it's not that profit's a bad thing. Profit is a great thing. Businesses should be maximizing profit. But conceptually understanding that profit is not an end unto itself. Profit is a means of achieving some greater purpose in the world, and for businesses themselves to understand what they're trying to achieve. Now, but I want to just ask you, where do you think that's really off? Or are we real, or does that make sense?
Let's dig into it and see. I think we're probably almost all in alignment. Maybe we are all in alignment. I think we'll see. But how do you maximize value? How do you make a profit? And I think that's where what you're talking about, I think, is going to be very similar to what I would talk about. And I'd say to maximize value, you have to have a great product or provide a great service. You have to be a mission-focused company. You have to have very satisfied customers. You have to have very satisfied employees. If you don't treat your employees well, they're going to leave. You have to have good relationships with the government. But I don't know if this is in conflict, but what we believe is that you can't serve multiple masters. The Bible talks about this. You have to choose a master to serve. And our belief is that the master for a for-profit, specifically public corporation that has a broad array of investors, pension funds, 401k people that don't have enough money to retire, that we don't have the luxury to sacrifice profits for a greater purpose. And so we believe that you have to focus on maximizing value, but by doing that, you provide so much good to the world. I don't think it's by chance that America has had more innovation happen in it than every other country. I think it's about incentives. And there are incentives here that if you innovate, if you provide a good for this country, you benefit for it with wealth. And I think that's what drives people to this country to innovate here versus innovate in other places. And so capitalism helps human flourishing. It provides a massive good, and you don't have to apologize or have to lower the amount of profits that you make to provide that good.
So I think that might be the way that we're able to sync up these two views and what's different from others out there that we might both disagree with. The idea that maximizing profit can be and is the way to actually create more value for everyone by integrating and aligning interests. Because what I will say is that there were some people that I worked with that believed that fulfilling profit is automatically taking away from other stakeholders, that the only way you're able to make more money for shareholders is by taking from the employees or the customers or someone else. Instead of recognizing that conscious capitalism as a philosophy actually says we want to find win-win-win solutions that integrates the interests of every stakeholder. But a lot of people out there actually still think all the stakeholders are in conflict, and that if you're helping shareholders, you're taking away from someone else, instead of, no, the way you help shareholders is by helping everyone else involved in a business.
Absolutely. And so some people call us the Milton Friedman funds. And if there's a criticism of Milton Friedman that we get sometimes is, how do you separate the desire for short-term profits, 1 quarter's worth of profits versus long-run profits? And as an asset manager that is mainly doing ETFs right now that are trying to help people save for retirement, you do want to incentivize the long run. And one of the things we actually get into is, well, what is the long run? And I don't think that that's actually been well defined. And to me, it also goes back to incentives. And when you think about the incentive system that we have in this country, you typically have CEOs that will vest their incentives over the course of 4 to 5 years. The average business cycle in America is 5 to 7 years. And so I can't tell you what's going to cause the next recession. I don't know what the world is going to look like in 20 years down the future. I don't think we should be incentivizing behavior in 2050, like net zero by 2050. I don't think you're actually properly incentivizing people to do that. I don't think that's also the purpose of a corporation to do that. I think that's the purpose of the people to set the rules of this country. But I do think you can properly incentivize behavior to maximize value over 5 to 7 years and provide a lot of good for all stakeholders while prioritizing the shareholder with that.
You've been running Strive Asset Management not for very long. This is still a very new company, right? How old is it?
So our first ETF launched in August of 2022. So we're basically just over a year. And I became CEO in April of this year. So it hasn't been that long. But like I said, we have grown very quickly. And I think we're going to continue to grow. And when I think about all the conversations that we're having and the excitement around us, this debate is not going to go away.
It is just heating up right now. And so what's been the response to Strive since you guys have started?
Mm-hmm. Well, if you Google Strive, you'll see anti-ESG asset manager, anti-woke asset manager, Strive Asset Management. And we have never claimed to be anti-ESG. It's never been on our website. To my knowledge, not one Strive employee has ever said those words. But we're labeled that, and I think that's really interesting and it's really telling. And it really talks a lot about how the media tries to use words to push down something that they don't want to see succeed. And so when I say we are not anti-ESG, what do I mean by that? And it's actually really important. So there's a debate of, is ESG good or is ESG bad? I think that's the completely wrong debate. And the right debate's actually upstream of that. And it's, what form of economic system or what form of capitalism do you want to incentivize as an asset manager, which is different than as a citizen, because the citizens of this country can change capitalism and we have to respect the vote, the will of the citizens. But encoded in American law, and specifically Delaware law, which is where most large corporations are incorporated, is a requirement to maximize value. Shareholder capitalism, shareholder primacy is encoded into law. And so that's the debate that needs to be had is, are we going to be as asset managers pushing value maximization or stakeholder capitalism, which is basically all stakeholders matter equally, deprioritizing the shareholder? That's the debate we have to have. Then when you go downstream of that, you can look at ESG or ES and G factors, because I don't think that they should go together. They're often in conflict with each other. But you can look at those different factors from the correct fiduciary lens to maximize value. And so how do we look at those different factors? When we look at the E, we believe that corporations need to have an eye to regulations, but we believe in an analogy that's basically a sports analogy, that the people set the rules of the road for corporations to then go and maximize long-run value within. It's like if you think about a football analogy. If football players said, hey, we hurt each other, we hit each other hard, we're causing CTE, let's not hit each other hard, that would be very ineffective, because what you would have is you'd have some players say, I don't care, I'm going to go hit hard. They would become the best players because they're not constraining themselves. And that's what happens, in my view, when you constrain some companies. Like if you constrain a large public company to drill less, well, if there's demand for oil, the private markets can then come in and some billionaire can come make outsized profits and pick up where Exxon might have dropped off, or another country, which we've called out before, like where China literally picked up a project dropped by Chevron to drill where they stopped drilling because of E factors, E constraints that were put on them by the large asset managers. So it's not only a breach of fiduciary duty, it's a very ineffective way to implement change in ways that you want to see. So that's broadly review for the E factors, we're also very pro-nuclear energy, which for some reason was a anti-view for the corporate ESG movement, but I think that might be changing right now, which I think will be a great thing. I hope it does.
I hope so too.
S. So a lot of S revolves around hiring. And we believe that corporations should hire the best candidate for a job, period. And I also don't believe that that's easy. And so we're very open about this, that sometimes people have implicit biases or things that might cause you to not hire the best person, but we also stand against quotas or mandates of hiring people or requiring sending the picture of a certain individual before someone will even vote on yes or no. Anything that's trying to implement a gender or race-based hiring system, we stand against. We don't. You would never do that in sports, and we don't think you should do it in corporate America. You should hire the best person. And I do think that if you are trying to hire the best person, you typically will end up with a pretty diverse crowd. Like we have 2 of our 5 senior leadership people are women, but it wasn't because we were looking for that. It's because they were the best person for the job. And I think that that's helpful for the company, but it's also helpful for those individuals, that it's like, I hired you because you were the best person for the job, period. And I don't think that that can be said sometimes in corporate America, and I think it's a problem. Malcolm Gladwell has talked about some of these things and some of the impacts that people have when they're hired or they're put into a college when they weren't qualified to do it. They actually tend to end up failing, and it's not a good thing. And so a lot of the research which we've debunked, and it was based on a lot of faulty statistics about why diversity outperforms, it frankly is just not provable either way. And so our belief is go back to first principles, hire the best candidate for the job, admit that maybe sometimes historically that wasn't what was done, but that should be our driving principle.
The one thing I do want to have a conversation about is when you say that businesses should really, going back to the example of Exxon giving up one of its projects and another oil company picking it up, and that being a bad fiduciary and strategy for driving environmental change. Are you suggesting that so long as it's legal, it's ethical, or is there a role for businesses to make decisions that this is what they stand for, these are their ethical principles that they're going to abide by, even if it's more stringent than what the law requires?
Maybe for a private company that has very concentrated ownership. A public company that has a diversified share ownership has a fiduciary duty to maximize value. And if you don't want to do that, if you want to lower the amount of profits or potentially lower the amount of profits you have to pursue a social purpose, there's a name for that. It's called a PBC, a public benefit corporation. And those are the types of corporations that I think can legally do that. But as an asset manager, I can't sit there and tell, now most of our clients are wealth managers that are managing money on behalf of their clients. The average client that they have has less than $1 million saved for retirement. The average 401k in this country has $100,000. I can't look as an asset manager those people in the face and say, hey, we're doing good and you're just going to have to accept less return. I don't think that they want that. I don't think most people do want that. I think it sounds great until you tell people that don't have enough money saved for retirement that it's going to impact their bottom line. And so as an asset manager, I think that we just, not only do I think that people wouldn't want it, I think it's our fiduciary duty to maximize value for them, but we can also have open conversations. So we can talk I can talk about certain things that might be in the best interest of society, but I believe the place to have those conversations is through the ballot box. I'm a big believer of the managerial class does not have a role to play in pursuing social or political agendas. And part of the reason for that, it's a lot of different things. One is the retirement crisis our country faces. But then secondarily, it quickly gets into the conversation of what is good in a politically divided country. And what I see happening in the corporate ESG movement is a pursuit of things for the left politically. And I've never seen something that is value destructive, that's something that primarily is supported on the right. I mean, for myself, I'm a unapologetic Christian. I have Christian values. And when I was at CalPERS and I was seeing a lot of the quote unquote good, for me, it was a fiduciary breach, and oftentimes I didn't see it as good. But why I think that what we tend to find is about 2/3 of Americans tend to agree with us is because there's about 50% or 45%, whatever you want to say, that would say the corporate ESG movement is doing bad. They're not even doing good. And so they already just don't like it for that reason. But then you also have a lot of people in the middle, independents, that say, I don't believe that corporations should pursue good. I don't think that's their role, even if I agree with it. I don't want to push my Christian values as the values of corporate America. I think that would be a breach, although I would think that would be doing good. I don't think that's my role. I also don't think it's the role of asset managers or corporations to push views of the left through corporate America.
What I think is interesting that you shared is the fact that there is a diversity of types of businesses out there under a capitalist system, and especially in the United States. Private companies, public benefit corporations, and then public companies. And there is the opportunity for businesses to be structured in different ways towards different goals. So you're not even saying every single business that exists needs to prioritize what you're saying they should, but publicly traded companies under certain rules with certain requirements should, and other companies can adopt other goals. Is that about right?
If you're a private company, if I start a private company and I'm the majority shareholder, I could set the rules that I want. Now, Strive would not invest in a company that wasn't trying to maximize value, but there's nothing wrong with someone setting up a company and saying, I want to pursue certain values. I believe Patagonia is a private company and they've pursued certain values for openly, right? But what's happened in America is that many of these companies were not set up with those clear values to do things other than maximize value. And then over the last 10 years, they've shifted, and they've shifted while being public companies that are majority owned by BlackRock, State Street, and Vanguard, but really underneath that, it's the everyday citizen through their retirement accounts are owning these companies. And to me, that is the problem, and something that people weren't disclosed, they didn't sign up for, they didn't agree to. I think part of it could be solved through disclosure. If I'm wrong, and if they all get disclosure from all their clients to say, yes, we want you to pursue certain values, then they technically wouldn't be doing anything wrong because their customers explicitly asked them to do that. But that's not what happened here.
I have one more question, then I want to open it up to everyone in the room to be able to ask you questions as well. But I asked you before, what's been the general response to Strive since you launched? What's been the response from companies that you've been considering supporting or that you have supported to Strive?
Yeah, it's been all over the map. And so some companies have been so receptive to Strive that they've done things like we've engaged with them and told them that we thought that some of their recent board additions that had been put on their board against the recommendation of the company were value destructive. They agreed. They just put new board members on without even a vote that were approved by Strive. So that's kind of the one like where real change has happened. And I think typically we've seen the most acceptance in the oil and gas industry. The oil and gas industry absolutely loves us. And part of it is they believe, and I agree with them, that they provide a critical good for human flourishing, but yet they're maligned like they're doing something that's critically bad for our country. And so the people that work in that industry are not fans of what's happened through this ESG stakeholder capitalism movement. The tech sector is a little bit more of a mixed bag. So like the opposite would be Mark Benioff at Salesforce. He's like, I don't think that even if Strive was a majority owner that he would change. He would be like, you're going to fire me, because he deeply believes in social change. I mean, left-leaning social change, but social change through Salesforce. And so it's been a mixed bag, and we tend to engage where we can actually make a positive impact, but we talk to all the different companies that we own.
Fascinating. Okay, I've got more questions, but I know other people do as well. So yeah, I will share my lapel so that others can ask. Yes, Jennifer, go ahead.
First, I'd love to hear how you're coping with winters in Columbus, Ohio, coming from a lifetime in California. But you made a great point about ESG sort of being entrenched in so many of these corporations. Do you think there should be a push to get more liberty-oriented ESG going in some of these areas? I mean, would that be a violation of the fundamental belief, which I think we all agree, that it's wrong, that this is not a good idea? But also, is it problematic, or should there be some push to get liberty-oriented ideas and values put in there, which could then it would eventually demise the system, or they could become wards of the state, as it were?
So to me, the first step is, and I think this is actually happening in this industry, is breaking up E, S, and G, because they're in conflict with each other so much. And I think that was actually a product feature, not a bug. And so they were brought together, although they're often in conflict, in my opinion, to push a social and political agenda. And so as you break those up, then of course every asset manager should look at all these different initiatives. And for me as an asset manager, I'm looking at them purely through the lens of value maximization. And the good news for your question is that that tends to be basically the same thing as liberty oriented. And so it kind of tends to do the same thing, but that's not the why of an asset manager, because it's not our fiduciary duty, but it's about incentive structure and incentivizing value creation, which is only done in systems that have very high liberty. But you should pursue liberty, for sure.
So slight shift of gears. So you obviously made a career change because it seems like you felt a conflict of sort of the values, right, of the previous organization that you were with compared to your own values. From a layman's perspective, it seems that in recent years, there's become a little bit more of a trend for your sort of baseline investor who's trying to figure out where they put their money and who they trust to manage their money, that there's a little bit more of a trend to go towards legal fiduciaries as opposed to your sort of typical asset managers, fund managers, and things like that. The book that came out, Money Master the Game, almost a decade ago, right, where these interviews were collected of all these different asset managers, kind of showed that the industry was kind of getting bogged down with excessive fees and things of that nature. I'm just curious if you have a bit of a pulse on sort of the demands in the marketplace. Do you think that the average person who's looking to do the wise thing with their money is now wanting to go towards a legal fiduciary as opposed to a typical fund manager, and what kind of your take is on the trend of the market and the market demand going forward?
I think it comes a little bit to what client are we talking about? And I have not seen that trend happen with the everyday citizen. When it comes to ultra high net worth individuals, what I've seen maybe even more than that debate is a movement away from ETFs and to what's called direct indexing. And their benefit of that is actually more tax loss harvesting, that they're able to take this index and look for, does Apple have a loss, and they sell Apple and they buy maybe Microsoft and Google to try to get a very similar beta. That's a big trend that's happening in ultra high net worth circles, but I have not seen a movement away from the large asset managers. In fact, the large asset managers just seem to be gobbling up every single asset that's out there. And so it'll be interesting to see if that actually starts to change, but it hasn't been something that I've seen yet.
I've worked in wealth management myself, so I'm super curious about the types of funds. So they're ETFs, actively managed, to have companies that follow the principles that you stand for. Can you give us a few examples of how they're constructed? Is the aim to be an alternative to the low-cost index funds you get from Vanguard with just those tweaks involved? Mm-hmm. Or have you felt more prone to get even more active in terms of picking the names?
So right now we have 11 funds. 9 of them are equity, and all of them are passive. Most of them are the largest sources of equity beta that would be desirable for people in their everyday retirement accounts. So like a 500 fund, a value fund, growth fund, small cap fund, those sorts of different things. And our belief is that this industry has had a race to the bottom with regards to fees, and that the wealth management industry has only looked at risk, return, and fee. And those are the only 3 factors that you look in when choosing an asset manager. Our belief is that it should be risk, return, fee, and corporate governance approach. That the vote and the voice, which the voice is actually a very important part of this because we engage with companies and that's where we actually find we make change, and same with our competitors. that matters in asset manager selection. And so our products are typically all within the range of somewhere between BlackRock, State Street, and Vanguard, but competitively priced with regards to fee, corporate governance differentiator. What's been interesting, and I think this is probably something that will pop out in the future, is that now that we've done this huge deep dive into every company, the board structure of every company, who are the board, do they support value maximization, do they support other things, who's in the C-suite, what's the incentive compensation structure, all that stuff is proprietary data to Strive. It was very hard to get. And we also were engaging with these companies in meetings and getting a pulse of how receptive are they to our message. That proprietary data will be very valuable in an actively managed fund, but not yet. Maybe next year. I'll tell you off air, because then my compliance friends would say I can't even like this post.
All right, Matt, thank you so much for coming out, for doing the course, for having this conversation. It's been a real thrill.
It's been a lot of fun. Hey, thanks.
Thank you.